things started to move again. After the quiet summer doldrums, the markets are waking up, and not in a gentle way. We're seeing a pressure on the indices, volatility picking up, and some of the leadership names are starting to break down. At the same time, gold is pushing up. Dollar is coiling for a move. This is where it's critical on how you're positioned when things start to move. So in this video, I'll walk you through what I'm adjusting, where I'm rotating, and the kinds of hedges I'm looking at to help you stay in front of the trade instead of reacting after the fact. Let's dive into it. First, let's talk about the jobs numbers. The non-farm employment change is forecasted to come in at 75,000. You can see the chart here clearly showing that this has been on the decline from 200,000 down to 100,000, now legitimately down there. But the big news is about the jobs revisions. Again, I expected another revision down in those jobs numbers. Now, Philadelphia Fed admitted that that the payrolls were overstated by at least 800,000, and therefore there are going to be revisions coming in, and the question becomes, does the market react on this? Well, let's certainly the stock market reacting negatively to this is possible. We're going to talk about this chart on the S&P in just a second, but let's talk about it from an interest rate perspective. Right now, the SOFR futures out to December of 2026 are trading with rates very close to 3%. Now, right now, we're going into this Fed meeting in a few weeks, expecting now a probability of 90% that the Fed is going to do one rate cut. The question is, if this number becomes quite negative in terms of the revision, the question is that will the market at some point start to price in a 50 basis point cut, which at this moment, there's almost no probability being assigned to this at all. But when we really look at it out to December, we can see the distribution, which is the probability of 2 rate cuts this year is around 49%, and the chances of 3 rate cuts this year is 36%. And so right now, the markets are still leaning the belly of the probability distribution that there's only going to be 2 rate cuts this year. The question becomes, if the jobs numbers are weak enough, will this spur in the third one? The one thing to watch in my mind is whether these SOFR futures start to, in some degree or another, price in another wave of dovish Fed cuts into next year. Right now, again, they're pricing in 3% interest rate. So we're talking about, something in the ballpark of 5 rate cuts altogether from September into next year. The question becomes, if the numbers become negative enough, could we see them pricing in rates to go even as low as 2%, which could be a move all the way to this 98 level? To me, this remains the most asymmetric trade out there. Why? Because the probability that the jobs numbers come in very strong and the bond markets have a big collapse and the Fed backs away from cutting rates is an outlier, and therefore the risk on the downside is manageable. Not zero, but it is manageable, and so therefore all of the tail risk is to the right tail risk of an upside move here. Therefore, it's one of my favorite trades to be putting on. But generally, if you're not trading futures, the way to look at this is that there's lots of impacts on this. For instance, the TUA, which is the simplified short-term treasury futures strategy, which leverages 2-year yields up to be as volatile as a 10-year bond. And this allows you to get a little bit of an extra kick while collecting a yield in owning 2-year treasuries, which is most sensitive to Fed policy. This could easily be ripping to $23 or $24, and it's an easy way for an average investor or trader to pick up a very safe bond yield and have participation in anticipation of a potential dovish pivot by the Fed, forcing them to cut far more, at least the market to price in far more rate cuts into next year. The bigger question is, will we see movement on the 10-year and 30-year bonds? Will longer duration bonds rally? And that really would come if the market started to sniff out a recession. That hasn't really risen as a possibility just yet. But what you can observe is bonds have generally been making higher highs and higher lows in the sequence higher, setting up for a potential rally and breakaway, which which would be the 10-year yield declining, exactly what the Trump administration wants at this point to stimulate U.S. housing. Will we finally see a rip in these bonds? The way to trade that is to put on tactical trades on the TLT if you're wanting to express your view that these interest rates are going to move that way. Now, TLT still has not started to move. It's a 20 plus year treasury bond, so the farthest end of the curve. But if we see any recession fears coming in, this is definitely the place where you're going to get yourself a market move. So let's talk about the S&P 500. Now the S&P is currently down 80 points at the time I'm recording this, but this is actually the first negative price action that we have seen in 4 to 5 months. What do I mean by that? Well, in the past corrections, they have been corrections of very robust rallies, and they often would just give back small fib retracements of the prior rise. What we have witnessed for the first time is a market rally over the last week and then a sell off that wiped out the entire rally. This is common with the characteristics of topping formations, which is also what we call distribution cycles. We recently posted a video on our YouTube channel about these different cycles of markets. And these are definitely some of the signs of distribution cycles. If you want to refresh yourself on that video, click on the link in the description of this video. So let's, looking at this chart, I want to highlight that we had basically a sell-off that wiped out the previous rally. This is a common characteristic of these rising wedges and or topping formations of a market that's very heavy. The one thing I've been adamant about is that while we have not yet seen the market start to technically break down, we were definitely in what is commonly the late stages of a market advance. Rarely do market rallies in the bull impulses last more than 3 to 5 months until we see a corrective phase, usually a 5% market correction on the downside at minimum. And so clearly we're overdue for one of these, and it's very likely that we're going to get one. Will we get be a garden variety 5% correction where we get down to 62 or 6,300? Well, that's definitely the base case. But the bigger question then becomes, does that create a negative feedback loop? Right now, if we see stocks like Nvidia starting a bigger topping formation and a bigger, deeper correction, which spurs a market rotation in the markets, this could create a distribution cycle in the AI space, which is so big at this point and so important to the market that it almost in itself could cause that 5% market correction just on its own. But if the story seems to be over and market participants are nervous about what is traditionally a very challenging part of the market in September, the bigger puzzle to solve is, will this spur a feedback mechanism where suddenly CTAs get all sorts of sell signals, and they've been net buyers over the last 3 months, and they may turn around and start closing their positions and or going short. You can have the vol targeting funds, which have been a huge flow of capital into the market, suddenly with a rise in volatility may be spurred to par down their positions, and you have all the short gamma that could be on dealer books that suddenly, if as the selling kicks in, they're going to need to be selling into weakness in order to stay delta neutral in their portfolios. This kind of negative price action is what spurred the tariff-driven Liberation Day sell-off. And the bigger question is that if we get a 5% correction, does that trigger one of these? Now, I don't want to say that it's a high probability, but this is when you want to be hedged, because the risk during these periods is where you're most fragile on this. So what are the things you can do to protect yourself? Well, one, you can open a traditional bear put spread on the market to complement your existing investments to blunt the potential downside risks, such as something like a 6,200 down to 5,800 bear put spread can be opened very cheaply, let's say out to October, and you can have yourself some protection that is giving you that 5+% hedge on the downside to blunt the overall potential volatility if this started to accelerate on the downside. Overall, the strategy here is you don't want to be heavily weighted into the things that have rallied the most, such as, for instance, the NASDAQ. Notice that the NASDAQ has clearly put in a pattern that often mirrors a head and shoulders topping formation. Now we're at a neckline. We haven't officially broken down, but you can certainly see where the vulnerability comes as the NASDAQ has been weaker than the S&P 500 up until this period. And so some of that sector rotation has found things like healthcare. And so there are definitely places to find, including, energy stocks have been doing fine. There's a number of places that you can actually see that rotation out of, let's say, some of these mega cap names and being redistributed into some of those things that have underperformed and are still cheap in value. We're seeing a lot of that kind of behavior happening underneath the hood. And so watching some of these defensive sectors as potential opportunities is certainly something to watch, and avoiding adding and buying more of these tech names is tactically the wrong time to be doing this. We have to see where and how deep a market correction goes here in this market environment. Now, I'm going to lightning round through a bunch of other things in the markets that I want to do some update videos for you in the coming days, but let's just quickly touch on it. Number one, the US dollar has definitely found a fair value zone, a period where it has found some stability in here. We're finally seeing a number of the cross currencies starting to move, like, for instance, a breakout today in that US dollar yen, another breakdown in the pound sterling due to some of the governmental budget policies going on over there. And so definitely seeing some potential for what could be a counter trend on the upside. Nobody's talking about this. No one's looking for it. Is the US dollar going to rip? Is that something I want to follow up with throughout the week? The other big thing to talk about is this monster breakout in gold. Gold has definitively broken out of this trade range and has some really exciting upside targets. I'm going to want to talk to all of you about some of the upside targets of where gold is going and how to trade it. The final thing is crude oil is attempting for the first time in a month to close back above its 50-day moving average. Are we seeing a potential new breakout happening in crude oil? And the last thing is we've seen definitely bullish advancements in uranium. The U308 is at 76.40, and we're seeing things like Sprott Physical starting to try to break out on the upside. While there's been a really amazing run in uranium stocks, uranium itself and the yellow cake have been left behind. And we're finally seeing some breakouts here that might be creating some new exciting opportunities in trading yellow cake here. We'll give you all a further update. So many amazing opportunities coming. The market has completely woken up here. Things are happening. There's money to be made. Keep following this channel. I'm going to keep you all up to date with what to do and how to trade it and what to look for.